When we think of 1929, we see the crash, the panic, the desperate headlines. The moment the world's most powerful market simply broke. But that focus misses the most important part of the story. You see, markets don't collapse because people panic. People panic because the system they trusted was already fragile. The real warning of 1929 didn't scream from the headlines in October. It whispered years earlier in places almost no one was watching. And that same quiet warning is starting to surface again. Not in stock prices, not in the news, but in the very structure of the system itself. Most explanations of the Great Crash are simple. Speculation ran wild. Everyone was borrowing money to buy stocks. Greed took over, reality bit back, and the whole thing came crashing down. There's truth in that story, but it's incomplete. Speculation doesn't destroy healthy systems, it exposes unhealthy ones. If pure speculation caused collapses, our markets would fail every other week. They don't. What really matters is whether the underlying economy can absorb stress when confidence finally breaks. In 1929, it couldn't. The crash wasn't the disease. It was the symptom. To understand why, you have to look past Wall Street and into the real economy of the 1920s. On one hand, productivity was soaring. Factories were churning out goods faster than ever before, but here's the problem. Wages weren't keeping up. All that new wealth was concentrating at the very top, while the average family's ability to buy things depended more and more on credit. People weren't buying new cars and radios because they were earning more. They were buying them because borrowing was cheap and easy. Debt became a substitute for a pay raise. At the same time, corporations were expanding like crazy, assuming this debt-fueled demand would last forever. Farms were overproducing, trying to make up for falling prices. Factories scaled up production. And all the while, inventories of unsold goods were quietly piling up in warehouses across the country. On the surface, the Roaring Twenties looked incredibly prosperous, but underneath, the system was dangerously out of balance. Growth was no longer organic, it was leveraged. Leverage is a fascinating force. It works like gravity in reverse. As long as everyone believes things will keep going up, it feels invisible. It makes everything seem lighter, easier, more stable than it actually is. But leverage doesn't eliminate risk. It just concentrates it. By the late 1920s, the entire financial system was running on a single, unspoken assumption that asset prices would keep rising and credit would always be available. This belief wasn't a law, but it governed everything. Banks lent freely. Investors borrowed heavily. Everyone assumed that tomorrow would look just like yesterday. In a strange twist, the very stability of the system became its greatest risk. There were warning signs if you knew where to look. Interest rates began to creep up as credit started to tighten. Industrial production actually slowed down months before the stock market crash, not after. Farm incomes had collapsed years earlier, quietly draining purchasing power from huge swaths of rural America. Even the Federal Reserve knew something was wrong. But the policy responses were hesitant, timid. The system had become so dependent on pure confidence that no one wanted to be the one to spook the markets and test its foundations. So, when the market finally turned in October 1929, it wasn't the shock itself that caused the collapse. It was the complete absence of resilience. Confidence cracked, leverage went into a brutal reverse. And the fragility that had been building for years became visible all at once. This is the part of 1929 we rarely discuss. The system didn't fail because people were irrational. It failed because it required constant, unwavering belief just to function. And belief once shaken, moves much, much faster than any government policy. Now, let's fast forward to today. That same dynamic is quietly returning. Our modern economies look very different on the surface, but the underlying mechanics are eerily familiar. Once again, asset prices are increasingly driven by floods of liquidity rather than fundamental productivity. Across households, corporations, and even governments, debt has once again stepped in to replace real income growth. Consumer spending stays strong, but only because borrowing remains easy and accessible. Central banks have become permanent, structural players in the markets, not just referees on the sideline. Their credibility and the promise of future support are propping up asset prices in ways that company earnings once did. Just like in the 1920s, stability is being assumed, not earned. And again, just like then, the real economic signals are diverging from the financial ones. We have economic growth but slowing productivity. Debt is expanding much faster than economic output. And financial markets react more to whispers about future policy changes than to hard data about the real world. Now, none of this guarantees a collapse. But it creates a dangerous dependence. Systems built on dependence don't break suddenly, like a tree branch snapping in a storm. They weaken quietly from the inside out, like wood being eaten away by termites. This is why timing a crisis is always misunderstood. A crisis doesn't begin when something finally breaks and makes the news. It begins the moment a system loses its flexibility, its ability to bend without breaking. By the time the stress becomes visible to everyone, the truly important choices have already been made, and the options have become severely limited. This is why a date like 2026 isn't a prediction, but a point of convergence. It's a period where multiple long-term cycles begin to mature at the same time. Debt cycles reach their natural limits. The effectiveness of policy tools, used over and over for decades, starts to fade. And powerful demographic, fiscal, and monetary pressures all begin to overlap and interact in unpredictable ways. History shows us that these major transitions often begin long before anyone can agree that they've started. Every era believes it's different. In the 1920s, they taught new technologies like the radio and the automobile, along with new financial innovations, had finally eliminated the old boom and bust cycle. In later decades, we were told it was globalization, or deregulation, or sophisticated monetary policy that made us immune. The language changes, but the pattern doesn't. Confidence reaches its absolute peak precisely when systems are least prepared for a shock. And when you let belief do the work that solid structure should be doing, fragility accumulates silently, hidden in plain sight. The real lesson of 1929 isn't about markets falling. It's about systems that mistake momentum for strength. Healthy systems can absorb fear and uncertainty. Fragile systems amplify it. When leverage replaces resilience and belief replaces balance, a collapse stops being a question of if and becomes a matter of when. History doesn't repeat itself perfectly, but it does leave fingerprints. And the warning that most people miss is never the loud, dramatic crash. It's the quiet moment right before it, when everything still seems to be working perfectly. That's the moment when a system truly reveals what it's made of. Thanks for watching. If you found this perspective valuable, consider subscribing for more content that looks beyond the headlines.